Russia's invasion of Ukraine is hitting the stock market hard. Take a look at the big board right now. You see the market is down 621 points. That's a little under 2%. Let's bring in Joe Saluzzi to discuss the major impact this attack is having on the markets. He's the co-founder of Themis Trading. Joe, thanks for joining us. You and other investors have been watching what's been happening in Ukraine over the last couple of weeks, last couple of months. Certainly, this is no surprise. We've heard the president of the United States over the last couple of weeks saying that this invasion was imminent. So what are investors saying now as they look at the market in the days ahead?
Yeah, thanks for having me on. And I think you're exactly right. We've seen, this has been leading up for quite some time. This is not, I hate to say it, it's not a surprise. The market was expecting this, and we've been building into it with a sell-off over the past couple of weeks. What we say right now, we're seeing, a continuation of that sell-off, about 2%, which, when you think about it, is not that bad considering, what's going on out there. I do think investors were prepared for it. I don't think we're going to get that much worse. The volatility index, which is a measure of investor fear, is at 35, which is pretty high. Anything north of 40, you're really starting to get nervousness out there. But right now, I think it's a relatively controlled sell-off. I think, things like gold, which you would normally expect to rally, initially rallied, but then pulled off. So that tells me maybe there's not as much fear out there right now. Now, if this thing continues and gets worse, well, then we'll have to see. But as of right now, the market is treating it as expected, I would say.
Joe, what is the market reacting to? Is it reacting to the sanctions? And we're hearing that more sanctions, severe sanctions are coming. Is it reacting to the uncertainty, the possible instability moving forward?
Yes, certainly the market hates instability. It hates volatility. It hates the unknown, right? That's the biggest problem with the stock market. If you can't predict things, we love to all predict earnings and growth rates and things like that. When you throw a monkey wrench into it, like a geopolitical concern like this, well, that throws all the models off. So you have to readjust your risk levels and so on. But outside of the Ukraine situation, really, the market is mostly worried about inflation. And that's been the story all year. And, part of that is geopolitical, but most of that is due to fiscal and monetary policy. That's a concern that's not going to go away, even if the Ukraine crisis magically was solved overnight. We still have major underlying issues in the stock market that we haven't addressed yet.
And so, Joe, the other question I have is, if you look at the weakness that we're seeing in the market today and over the last couple of weeks where you've seen this selling off happening, but on the other hand, for some of the companies that you own, for example, in your portfolio, the fundamentals are strong, right? You bought those companies because you believe in their long-term growth projections. That hasn't changed.
Right. And actually, our job, we're actually agency traders. So we trade on behalf of institutions like hedge funds and mutual funds and pension funds. I'm working my orders right now. I'm on the trading desk behind me. I've got buy orders on the desk. To your point, I've got investors who are seeing values saying, hey, I like this stock. I already own it. In fact, I'd like to buy some more because I think these levels are good. On the flip side, there might be some sellers out there as well. But yes, when you're looking at stocks, you have to look at a long term. You have to look at where's your risk horizon? What's your parameters? Of course, there's geopolitical concerns. Of course, there's the Federal Reserve. But what do you think of the fundamentals of this stock? Is this something that you like in a year or two from now? And when you're trading on behalf of institutional investors, they look for longer term. So days like today do create some values. You're not going to jump all the way in, but we do see people dipping their toes back in.
So you described, Joe, institutional investors. You're trading on behalf of those institutional accounts, and they see the dip in the market and they see a buying opportunity. On the flip side, you've got retail investors. I'm going to ask you to put on your analyst hat a little bit here. Retail investors who don't think as institutional investors, they often get emotional when looking at the stock market, and they turn on their TV or they turn on,
they get on their app.
They get on their app.
Are you talking about someone you know?
No, not me. But they get on their apps and they see the market is down 2%, and they get worried. They call their financial advisors. What would you recommend that people do who wake up this morning and they look at their 401k? It's already been down sharply throughout the course of the year. Now it's down even more sharply this morning.
Yeah, that's a great question. And I do think it depends on your level of risk. If you're younger and you're trading from an app on a Robinhood style, or you're trading crypto like the young kids all do, that's different. That's trading, that's short term. And I do think people are flipping in and out of positions and they are getting nervous quickly. If you're a little bit older and you're saving, like you mentioned, for a 401k, well, these are not times to panic. Certainly not. I'm not concerned in my personal 401k about the geopolitical situation. I am more concerned about the inflation and the growth situation here in the U.S. as well as in Europe and other countries. I am looking at that, considering whether or not I want to rebalance. So, you're balancing, you're not 100% equities. If you're 100% equities in a 401k, you're probably living a little dangerously. So maybe you can rebalance it and tweak it a little bit just to take that risk level down some. A general thought is, if you're going to sleep at night and you're worried and you can't sleep, you have too much risk exposure. You should be taking that down and taking it down soon.
All right, so everyone takes your advice and they don't bother looking at their 401k for now. That's fine, but then there's just day-to-day living, right? Can you afford the groceries? Can you afford the gas to fill up your car? Can we expect this instability to have an impact on just the day-to-day prices? Or I guess that was happening already, but can you see us paying more for gas and other things directly connected to the instability we're seeing in Eastern Europe?
For energy, yes. For gas prices, I do think that you will have supply issues going on there. However, I think to your point there, the other way, inflation was going on already prior to this situation. We've got the Federal Reserve, which is indicating they may go anywhere between 5 and 7 rate hikes this year to tame that inflation, which is north of 7%. This is very scary. Inflation is what the market really hates. And there's one word which is even worse than inflation. It's called stagflation. Stagflation means you have a slowing economy and you still have inflation. That's the death to the stock market. That is the worst word you can say. You're kind of heading in that direction. You have to be very careful here. The Federal Reserve is walking a tightrope, as well as other central banks like the ECB. Do you raise rates? If you raise them too much, you then may squash growth. If you slow down growth, but you don't slow down inflation, you've got a major problem on your hands. So the Federal Reserve and the other central banks put themselves into a box over the past decade by doing what they've been doing, what's called quantitative easing. We now have to kind of come up with some big decisions, and I think that's also what's worrying the market, and that will stay here for quite some time, not just this week or this month.
So let me just get your take on what one Federal Reserve president said. James Bullard said that the goal in bringing inflation down, Joe, would be to target a neutral target rate about 2%. So the Fed would have to raise rates about 100 basis points before July. Do you like that move or no?
Bullard's a hawk. They call him. He's one of the hawks on the side, right? There's hawks who want to raise things quicker. There's doves who want to be a little bit slower. I think it's somewhere in between. I do think they will raise rates. I don't think they're going to go 100 basis points right away. They'll probably go 25 now. 50 was kind of priced in. Maybe they'll start with 0.25% because of these geopolitical concerns and because of what I said before. If once you press your foot on the gas pedal, if you go too far, you can't just go backwards. You then have a problem. So the Fed's managing what they can do here, and they are very smart. And they've been doing this for many years. So I think rate hikes are in the cards for sure. I do think they might slow it down a little bit just because of the fear of if we do it too much, the economy is going to slow too much, and then we're going to have a bigger problem.
Joe Saluzzi, thank you very much. Really good conversation. Appreciate it.
Thanks, Joe.